Okay, let's dive into this. Welcome to today's Explainer, where we're putting on our expert investment analyst hats to tackle one of the absolute most fascinating questions in modern finance. How exactly do you value a high-growth, cutting-edge tech stock using the classic, time-tested valuation models of investing legends? Today, we are running a company called Arteris Inc., ticker symbol AIP, through what I like to call the Guru Gauntlet. We're going to apply the incredibly strict philosophies of Warren Buffett, Peter Lynch, and Benjamin Graham before layering on modern discounted cash flow and comparative models just to see what this stock is truly worth. But before we run the numbers, we really need to know what we're valuing here. Arteris is a semiconductor intellectual property company. They create something called network on chip or NoC technology. Honestly, the easiest way to think about it is like a central nervous system. It's the vital communication backbone inside complex system on chips. See, Arteris doesn't manufacture the physical silicon itself. Instead, they license out the incredibly complex architectural IP that allows different processing blocks, like your CPUs, GPUs, and memory, to actually talk to each other efficiently. And that puts them right at the beating heart of massive megatrends like artificial intelligence, machine learning, and autonomous driving. So, here's our structured roadmap for the explainer today. We'll start with an Arteris company snapshot, then apply the Warren Buffett, Peter Lynch, and Benjamin Graham lenses. After that, we'll dive into DCF and valuation models, and finally, wrap it all up with our final investment synthesis. Let's kick things off with Section 1, the Arteris Company Snapshot. We've got to understand the current playing field first. Right away, the numbers reveal this incredible tension. As of mid-2026, Arteris is trading at $30.99, which gives it a market cap of $1.4 billion. Now, the top-line growth is honestly explosive. Q1 2026 revenue jumped 39% year-over-year, and they're securing some absolutely massive contracts. But this is completely offset by the bottom line. Their trailing 12-month net income is a painful loss of $34.6 million. So we've got this deeply unprofitable company with blistering growth and a billion-dollar valuation. How in the world do the legends handle this?
Well, let's find out in Section 2, the Warren Buffett lens.
Okay, so Buffett loves a strong economic moat. And believe it or not, Arteris actually has a really good one. Once a chipmaker goes through the trouble of integrating Arteris's interconnect IP into their silicon design, the switching costs to rip it out for a future chip are incredibly high. It's sticky. Buffett also demands manageable debt, and Arteris passes that test with flying colors. They have a pristine debt-to-equity ratio of absolute zero. But then we hit a massive wall. Buffett strictly demands consistent, predictable earnings and a high return on equity. With a trailing 12-month earnings per share of negative 79 cents plus negative net income, Arteris instantly breaks Buffett's core rules for consistent profitability.
And this brilliantly illustrates the final nail in the coffin for any sort of Buffett-style investment here. He looks very closely at owner earnings, which we're approximating here using free cash flow. Over the trailing 12 months, Arteris has a negative free cash flow of $4.69 million. Because Buffett requires a definitive margin of safety, one that's based on predictable positive cash generation, he just wouldn't buy this stock at any price today. He'd take one look, place it in his famous too hard pile, and walk away.
Let's move to our second trial in Section 3, the Peter Lynch lens. Lynch might be a little more forgiving of a hypergrowth narrative.
Lynch famously loved to categorize companies into different types, stalwarts, cyclicals, or fast growers. Arteris firmly belongs in that fast grower category. The huge 39% jump in quarterly revenue, along with their remaining performance obligation, which is essentially future contracted revenue, swelling to $118.3 million, absolutely proves this business is expanding rapidly. Lynch would also really appreciate their strong balance sheet. They're boasting $11.7 million in cash with zero debt, which means they aren't at any immediate risk of bankruptcy while they aggressively chase that growth.
But remember, Lynch was still a fundamental investor at heart. He relied heavily on the PEG ratio, which is the price to earnings divided by the earnings growth rate, to figure out if a company's growth actually justified its premium price tag. He typically looked for a PEG ratio of 1.0 or less to indicate that a stock is fairly valued relative to its growth.
And here is where the analytical tension snaps right back. You physically cannot calculate a valid, meaningful PEG ratio when a company's earnings are negative. Arteris currently has a PE ratio of negative 40.8. Because they're operating at a loss, the entire PEG formula just breaks down. So a strict Lynch-style investor would likely issue a hold/sell opinion here, treating this as a purely speculative play until institutional ownership drops enough to risk it or profitability finally emerges so a true PEG can be calculated. All right, time for our strictest test yet. Section 4, the Benjamin Graham lens, the father of value investing himself. Graham utilized a ruthless, totally unforgiving defensive investor checklist. So let's run Arteris right through it. Adequate size? Pass. At $1.4 billion, it clears Graham's typical minimums. Strong financial condition? Pass again, thanks to that beautiful zero debt balance sheet. But from there, it is an absolute bloodbath. Dividend record? Fail. It pays literally zero yield. Earning stability? Fail. They're deeply unprofitable. Moderate PE and price to book? Fail. The multiples are either completely negative or sky high. Arteris utterly fails the defensive test. But we're not done, because Graham also left us his famous formula to calculate the absolute intrinsic value of a stock. He demanded a margin of safety below that specific number. So, I want you to consider the mathematical reality of applying a 100-year-old value formula to an unprofitable modern tech stock. What do you think happens? It literally breaks the math. Look at this. Graham's formula is the square root of 22.5 times earnings per share times book value per share. Because Arteris has an EPS of negative 79 cents, the formula is asking us to find the square root of a negative number. That's a mathematical error. It proves definitively that Benjamin Graham wouldn't touch this stock with a 10-foot pole. Okay, let's pivot sharply to modern quantitative methods. Section 5, DCF and valuation models. Let's move to and see how this builds when we project the future, rather than just punishing the past. Since historical free cash flow is negative, we have to base our discounted cash flow model on management's own forward guidance. Arteris guided for positive free cash flow in 2026 of between $5 and $9 million. We'll use the $7 million midpoint for year one and forecast out 5 years of aggressive cash flow growth. Now, because this is a high-growth, inherently higher-risk semiconductor IP company, we have to apply a stringent discount rate, or WACC, of 11%, and we'll assume a standard terminal growth rate of 3% for the perpetual value. When we crunch all those numbers together, our base case fair value lands at exactly $13.10 per share. But hey, let's look at the sensitivity table. Even if we tweak the inputs for our most wildly optimistic scenario, dropping the risk discount down to 10% and pumping the perpetual growth up to 4%, our fair value only stretches to $18.50. The stock is currently trading up near $31. Our DCF models strongly suggest the stock is vastly overvalued right now based on the actual cash it's realistically going to generate. And we can easily confirm this using our other models, like comparable company analysis. Because earnings are negative, we have to use price-to-sales multiples. Arteris is currently trading at an astronomical price-to-sales multiple of 18.3. Just to put that into perspective, industry giant Qualcomm trades at just 4.1 times sales, and the broader S&P 500 is sitting down at 3.3. If Arteris were valued at a generous sector median multiple, its implied share price would plunge to around $7.50. This visually shows us just how massive of an AI and growth premium is currently baked into that $30.99 stock price. So let's bring all these frameworks together. Section 6, our final investment synthesis. So the crucial point is this gaping chasm between intrinsic value and market price. Graham's formula fails completely. Our pretty generous base case DCF values the company at $13.10. Our comparative peer model implies a value of around $7.50. And yet the market is happily paying $30.99 today. Essentially, the market is pricing in years of flawless, uninterrupted future execution right this second. When we weigh the strengths, and they are real strengths, like a flawless, debt-free balance sheet, incredible 39% top-line revenue growth, and a business model perfectly positioned for the AI megatrend, against the risks of deeply negative trailing earnings and a valuation that is literally priced for absolute perfection, the analyst's verdict becomes pretty clear. At $30.99, this is a blended hold or sell recommendation. It is simply too expensive for a fundamental investor to initiate a new position without a massive margin of safety. But exactly what would make these legends change their minds and finally hit that buy button? Well, Buffett is going to stay firmly on the sidelines until Arteris produces years of sustained positive owner earnings. Lynch? He'd wait for the net income to cross into the green so he can finally confirm the PEG ratio is under 1.0, proving that the growth is actually cheap. And Graham? Honestly, he's waiting for consistent, positive EPS and a reliable dividend yield, meaning he might be waiting decades. Which leaves us with one final, really profound question for you to ponder. Arteris is an incredible company. They are literally building the architecture of the future. And yet, it fails almost every traditional valuation metric. So, does the undeniable, world-changing momentum of AI megatrends justify completely ignoring a century of proven value investing principles? It really is the ultimate battle of momentum versus fundamentals. Thanks so much for joining me on this explainer, and I'll see you in the next one.